KEF Connect. Conversations that matter. Tune in every week for interviews with industry trendsetters and community changemakers that will instill inspiration and ignite action. Visit www.kefholdings.com and click KEF Connect to listen.
All right, welcome to the next episode of KEF Connect, which is the podcast series that makes a difference, connecting listeners to the trendsetters and trailblazers, creating an impact in their industries and communities. Again, this episode is going to be talking about money. But what about money? We're going to be focusing a lot more on investments. With me today are three exceptional people who really have had their hands, feet, and I guess all of themselves into the investment world and the banking world, which I think is very confusing for a lot of people, but also very equally interesting. I'll start with Prashant Mehta, who is the Chief Investment Officer of KEF Holdings, with decades of experience working in the banking industry, skilled in investment advisory, mutual funds, management, trading, and structured finance, with a very strong financial professionalism with Kaufman Fellow, focused in venture capital and investing from Kaufman Fellows program. He is also an adrenaline junkie and actually loves anything from skydiving to water sports. So definitely someone who knows how to dip into risk. So really looking forward to hearing a little bit more about that as well. Next up, we've got Malika Chandra. Malika has over 20 years of experience in the banking industry, during which she has consistently built very strong ecosystems. She's also worked with large global banks from across India and MEA. Currently, she is the CIO at a single family office where she leads a team of investment professionals. And finally, I want to introduce you all to Santosh Keni, who is the Chief Executive of Pantheon Global. He joined Pantheon Global as Chief Executive in 2015 when he was invited to establish Pantheon Global and is responsible for overseeing the firm's investment activities across various asset classes and geographies, along with driving strategic direction of the group. Previously, Santosh has held quite a lot of roles. I start off with the head of Middle East and South Asian business for Coutts & Co. And he's also held quite a lot of leadership roles at Barclays and Citibank across the firm's wealth management, treasury, and equity trading businesses, both in Singapore as well as Dubai. All right, so I have a first question, which is a very general question for the three of you. So in our first episode, there was a lot of talk about investing. So I want to start off, we'll start obviously with Prashant, just to understand, what does investment actually mean to you? And I would like to look at two different categories, right? What it meant for you before you got into investments and what it means to you today as you're working in investments.
So I think the way to look at investments, I'll break that question into two pieces, right? I think what does money mean to you first, right? And it really depends on what is that pot of money that you're looking at towards the investment, right? So, and depending on how large or small that kitty is for investments, and what is the end purpose for which you're investing towards, right? If the end goal is, let's say, my daughter's education, right? Or if it has a finite purpose on a finite date, right? Then that investment has to be a low return or maybe a higher safety instrument, right? But if the end goal is, let's say, I want to buy a car, right? And let's say you plan to buy a car in 2020, you'd put aside a pot of money that you wanted to grow towards it being for that car in 2020, but COVID hit and you had to probably buy a car maybe a year later. It doesn't move the needle for you so much. Right? So I guess investing for me is about what that end goal is, right? And once you can define what the purpose of that investment is, then you can sort of backtrack towards where that money should go.
Very interesting. Malika, your perspective on investment.
Before and after?
Before and after, yes.
So I guess before was very ad hoc, right? You got $2. Probably you just want to buy a house or you just want to buy a share, for any company. And so literally with no objective in mind, right? You probably wouldn't even have a strategy. how and why you want to look at that even $1 that you have for spend. After, I guess, you define your objectives, where you want to see, how you want to see the dollar that you have to grow. Whether and I guess you really define your timeline. In 5 years, I want to see that $1 to probably 2. In 10 years, I want to see to 10. And so I guess investment is about having a defined objective and also a process for it.
Good. Santosh?
Okay, I'd like to just kind of take a step back. I was exposed to investments at a fairly young age.
Very good. Yeah.
From a perspective...
What's young, though?
Probably in my teens.
Okay.
Okay, it was basically a function of value for money, more to start with, before the investment part of it, right? So it came from my father, it came from my mother, it came from my grandmother as well. So so again, the whole concept of understanding the value for money was very important. Came across very young. And the thing was, what do you do with that money? How do you basically end up making sure that, you actually end up having some sort of financial liberation? Or you actually feel that you've actually got, at a particular point in time, the idea was, when you actually hit 60, you retire, you actually need to have, some sort of a financial a backup to make sure that you don't necessarily have, a regular income. How do you compensate for that, and so forth? So that was what was actually kind of drilled in. By and large, I think most people have a tendency to kind of, follow the herd, or basically, speak to their friends and family and see what they're doing and so forth, right?
Yeah.
I think it is important for people to start recognizing that objective. I think that key thing is that objective. And one thing that actually, again, I'm sure we'll talk about as well, is the power of slow compounding, right? Or consistent compounding. How do you make sure that you actually have that investment? It's almost discipline of staying invested or keep investing that money through various cycles.
And various stages of your life as well.
Absolutely.
All right.
Absolutely.
All right. You brought up a really good point because, and that was actually going to be the segue to my next question, Santosh, which is, do you need to save in order to invest, right? Because right now, I think a lot of people are looking at how can I get capital from others? If I get people to support it, I have a great idea. I have a great concept, would people give me money and then maybe show some sort of ROI over a period of time? So do you need to save in order to invest? I'll start with you because we ended with you, but I'd really like to hear from Malika.
All right, so let me put it this way. That's not investment. That's a venture.
Okay.
You're actually looking for capital from investors, other investors who are willing to take a bet on you. On a person, on an individual. I think that's really a venture. So that's not really investments. Investments purely is a function of the money that you've actually got.
Okay. As an individual. So you've earned it, you've got it.
That's right. And the money that you've actually got, can you generate either income or growth of that capital, or both? How do you do that?
True. No, I couldn't agree more with Santosh. So yes, that is... So one, that's venture, right? If you're asking, and two, is savings important from a investing perspective? 100%.
Absolutely.
Right? So it's what you need to think about it from an investments perspective is how much does my money earn for me while I'm sleeping, right? If I've taken somebody else's money and I'm using it to fund a venture, I'm still making money for them on their money. It's not my investment.
Very good point. Malika, anything to add?
Sure. I think, let me just explain it with an example. As how I see it. Like, for example, I have a cousin who probably started his business, let's say, 19, right? When he was 19 and from college. So he had an idea. He was looking for VCs who would invest in his business, right? And he grew it and sold it by the time he was 28.
Wow.
Right.
Okay.
So that is not investment. That's creating an idea, building up on it, making a business and selling it. But now what does he do with that money after selling it? And that is where it comes investments, right? Because he cannot be making businesses every 10 years. And he's already done it once. So this is where I think the investments come in. You have a pool of capital, and like Prashant said, you want it to generate, returns for you.
Yeah.
And with whatever objective that you may have, you wanted to grow, like Santosh was saying, slow compounding, maybe 10, 12%, maybe higher. Like maybe the return objective for somebody could be like, I want to grow my money at 25% higher. So where do you invest? If you're a high-risk investor, probably you will invest in other businesses.
Yes.
And there are many VC funds or growth stage funds. That is investments.
Yeah.
If you wanted slow compounding, maybe you will take more traditional products, right, which are not as high return, but less risk as well.
Yeah. So low to medium, approximately.
Yes.
Okay. So this brings me to another question, because we've talked about slow compounding, we've talked about VCs, and we've talked about where the investment starts after you've started saving.
Yes.
I think the biggest question that many people are going to wonder is, how do you start investing, right? What does that actually mean? Not for somebody who has the money and has the knowledge, right? I have some capital. How do I spot an opportunity, and how do I know that this is a good investment? What's the takeaway there?
I'll go back to your first question, right? When you said, what does investing actually mean to you, right? And this is essentially what happens when you start investing. You go out and you start seeking people. I get a lot of people that come and tell me that, you're from the field. Tell me, where do I put my money?
Yes.
Right? And I guess that's a very common question that
Yes.
we'll all get. Tell me, what's the next big opportunity? Opportunities exist in everything that you do, right? And they're there in your most trusted set of people, right? You could, depending on what is that pool of capital. I'll give you an example. I have a friend of mine. He came to Dubai, and he's a photographer, right? He wanted to set up his business here. He was hiring his camera every time that he was going out and doing a shoot, right? Each time he hired the camera, it cost him 250 dirhams, right? The cost of that camera was 12,000 dirhams, right? But he was needing it, if I remember right, give or take about 14 times a month, right? Okay. I said, let me buy you the camera, right? And you pay it off over a period of time, right? I knew that I was buying equipment for him. I knew I was going to get a set of return from him. I knew that this was a person that I could trust, right? It could be something as simple as that, right? It really depends on what is that pool of capital, right? And that pool of capital could range from 5,000 dirhams to, I don't know, $500 million, right? But the opportunity set comes really close to you, and you need to be, and it's a person that I'm able to evaluate. It's a person that I trust. When you start investing, you're going to have to start investing with trust and belief, and the fact that you're able to see what's coming back. Over a period of time, you refine that, right? So you see, so with him, I've done a couple of other things. So from his camera to, we started doing the 360, to doing like a bunch of other equipment, because he realized that, eventually he owns the cameras, right?
Yes.
And it just made sense. It was a win-win for the both of us, right?
Yeah.
So I guess the opportunity is about providing capital to the capital starved, but with that bridge of trust in between.
Because
Yes.
I think lots of people keep wondering, where do I start? Do I invest in bonds? Do I invest in stocks?
True.
Do I invest in because the word investment is only usually, I would say, maybe 80, not only, maybe 80% of the time is like
Financial instruments.
exactly, things that you can't touch. Let's Bitcoin, and let's do I don't know, bonds, and let's do. So I think people need to see, actually I can invest in something. This podcast room is a classic example.
Absolutely.
Let's create one, because we know people will come out of it, because there's knowledge that comes out of it, because we trust the individuals within it, and so there's an outcome for it. Malika, any feedback from your end? Opportunities, where do you spot them, and how?
For us, opportunities are plethora, right?
Okay.
But are we talking about the watches here, right? And if we're talking about very simple, probably somebody who's probably even got $50,000, right, or maybe even $10,000, how do they see opportunity, right?
Yes.
So one, like Prashant mentioned, it could be investing in the business, but if you're really looking very simple, like you said, the financial instruments like bonds or equities, I guess it has to come in from somebody from you trust. But who do you trust? Like if the person sitting next to you is as novice as you are, right, then you won't be able to trust, because
Yes.
you don't know how good the knowledge the person has.
True.
Right. So Santosh, what do you think? I mean,
Can I just talk about a particular quadrant that I look at.
Yes,
Yeah.
absolutely.
Okay.
Absolutely.
For the listeners, visualize a box, and then and divide that box into 4 squares. So you have your x-axis, which is the bottom row. Think of that as your liquidity, and on the other side, on the vertical axis is your risk. So let's start with the bottom left corner.
Yes.
So that is your low risk and high liquidity. That's your first quadrant. And the second quadrant is your, you actually move upwards from quadrant 1, which is your quadrant 2, which is your high risk,
High risk.
low liquidity. High risk and high liquidity. And your quadrant 3 is, at the bottom right, which is your low liquidity, low risk, and then the top, which is basically your high risk, low liquidity. So if you look at these 4, and that's just kind of framing this discussion, and you guys can actually kind of please jump in as well. So if I look at it in terms of coming back to objective, right? So if I actually have an objective saying that this money is very dear to me, I really can't look at it from, there is an objective, which is savings for whether it's, child's education, for someone's wedding, whatever it may be, or for my education, for instance, right? I would actually end up saying, all right, start looking at quadrant 1, because I need to ensure that, that the money is tangible. I can, I know that I need it. I can't take huge amounts of risk. Perhaps you can actually maybe graduate from quadrant 1 to quadrant 2, which takes slightly higher risk. So what comes in quadrant 1? Let's start filling in these blanks, right? So quadrant 1 would be stuff like, deposits, right? So you end up keeping it in deposits. Guess what? Deposit rates today are next to nothing, right? So you say, all right, fine. What else could probably qualify for that in terms from a risk perspective? And then you'd start looking at maybe bonds, right? Maybe government bonds. And then you would probably end up going down, the risk curve, or what we actually call the risk curve, saying that, maybe take something slightly higher risk, maybe a corporate bond or so forth, right? Lending monies to somebody else, who's good and credible to repay you back. So you're the lender of your money.
Of your money, yeah.
Right? And then you actually end up saying, oh, you know what? There is a portion of my wealth or of my money that I want to keep it there because I want it to be safe. But there's also maybe another portion of my wealth that I want to make sure it grows as well. So there's an income element that I'm coming from quadrant 1. And there's perhaps, a growth element that's coming from maybe some of the other quadrants, right? So quadrant 2, which is high liquidity and high risk, is equities, for instance, right? So you basically say, all right, you know what? Let's actually look at that. Why is it high liquidity? Because you could sell a stock in any of the stock markets immediately, but it's high risk. It requires you to actually end up doing a fair amount of research.
Yes.
Now, what's also happened over the last few years, actually last many years now, is the dearth of what we actually call as exchange-traded funds, passive money. So you don't necessarily need to go out and start looking at identifying an individual stock or a company. You could do that. You could actually employ the resources of specialists, or if you don't necessarily have the resources, you could actually end up saying, listen, you know what? Consistently, the equity markets, let's say, for instance, again, whether it's the US or whether it's in India, whatever, whichever region or geography of that, of your choice or your home state is, you basically look at it over a period of, let's say, the last 25 years, 20 years, or 30 years, and you'd say, all right, it's consistently compounded by itself. So you know what? I could actually end up playing very passively by buying
just the ETFs.
The index.
Absolutely, right? So if I could just add on to what Santosh is saying, right? I think what you're talking about, Santosh, is this journey from trust-based investing to education-based investing.
Correct.
Absolutely.
So
right?
I possibly want to add over there.
Yes,
So my
absolutely.
question to you was because we are into the investments, right? We see so many opportunities, and people who do have a meaningful amount of money, will have that access, right, to the specialists. They probably will be having a private banker, guiding them how to invest, where to invest. But
or they would know a Santosh or a Malika or a Prashant, right? So yes, you're absolutely right, actually, and that's a very valid and very fair point as well.
But for the people who probably do not have that kind of a pool of money, that they cannot afford this access because those bankers or these specialists, right, will not be approaching them, right? How do they invest?
And this is where I was coming from, saying that, listen, you don't need, or perhaps you don't need as much of an expertise of individual or private bankers or investment specialists. And that is why there's been this massive explosion of passive investments.
Absolutely.
Right? So what is passive investments is, for a lack of a better word, it's just basically a very simplistic way of partaking in capital growth.
Absolutely.
Right? And you could actually end up investing in an index, which is through these exchange traded funds, that has as much of a liquidity as you would have off the stock.
Okay.
And the idea is, again, so I think it comes down to discipline, right? The discipline is, can you actually stay invested over a period of time?
Absolutely.
What is your investment horizon?
Prashant, you were about to say?
Yeah, so like I was saying, right, if you start with this trust-based to this education-based investing journey, right? My dad used to work, with Western Railway, right? But over the years, he's built a phenomenal portfolio. So my dad's 80 today, right?
Wow.
And he doesn't have a dime in fixed deposits, right? My dad's 100% single line equity investor, right? So he doesn't have funds, he's not done passive. But, again, the journey starts out with saying, okay, let me start by doing this, right? And it's how much money do I have that I'm able to risk, right? So you start to read, okay, so if I invested in a automotive
Stock.
right? So let's say I invested in Ford or a Maruti, right? So as those stocks started to do well, it's like, but these guys need components, right? Let me look at the guys that manufacture the tires. Let me look at the guys that manufacture the windscreen, right? And he started going down that path. And the more you educate yourself, I guess, if you invest only trust-based, then when the markets go down, you're going to have to call that advisor and say, what do I do?
Yes.
And at that time, your trust is shaken. But if you have information, if you are educated, and you know your numbers, you know that car sales are up so much, so they will need so many tires, you're able to digest that a lot better, right? And I guess so for any listener out there, I think, as you start out on this journey, remember that whatever you do, you might do passive investing, you might do active, you will need to educate yourself, right? If you don't educate yourself over a period of time, you will come to a point where you just cannot take the volatility that's associated with investing, and you say, this is not for me.
Yeah.
Right?
Yeah.
But it's not for you because you didn't bother to read.
Yes. Yeah.
Right?
So not just invest in something, invest in yourself.
Investing in yourself is first.
Is the number one thing. Okay. Got it. Okay. I want to switch the questions around a little bit because I really want a personal anecdote. Let's start with Malika. What was your first ever investment? Not work related. Let's not talk about what you're doing right now.
Oh, no.
And I want to know, how did you feel when you did it? The emotions that went with it, and who guided you into that process?
It is very interesting. I think that was way back in 2001. So I had a colleague, and he was probably as young as me, but he probably started investing in stocks maybe when he was 30.
Okay.
And I had just started my career, and then he tells me, Malika, do you have a trading account? I said, what is that? So he said, no, you must.
Okay.
So he pushed me, and within a week I had a trading account, and then he tells me, just buy the stock. Okay. I was like, what is it about? He said, I don't know either.
Trust-based.
Yes. But I think it's going to multiply.
Okay.
I said, okay, how much should I put in? He said, as much as you feel comfortable.
Okay.
Right. So it literally started with that. How much can you spare?
Okay.
And I did that.
And so just for, again, the listeners again, you were happy to let go of that amount.
Absolutely.
Regardless of where it sat within Santosh's quadrant.
Absolutely.
Okay.
Absolutely.
Just to make it clear, because people are like, what? What do you mean?
But it also depends.
Santos's quadrants actually are a post effect of having managed money, right? Now you realize I can do this or I can do that.
Yes.
When you start out with a small pool of capital,
Yes.
you're not thinking, oh, do I do liquidity? Do
Yes.
I not? It's only when you come across that roadblock, you're like, oh, I should have probably managed it. So there's a lot of hindsight that we're putting into this discussion today.
Yes.
And if the listeners are out there, they should manage it that way today.
Yeah.
And that's something that we learn now.
Agreed,
right?
yeah.
And it's years of experience in that four boxes. That
I think what's interesting about that quadrant, and I think where a lot of people is, many people, they say if you want to remember something, you need to write it down. And so, Malika's experience of having this, 13-year-old wonder guy who started trading at 13.
Exactly.
Didn't have it written down. It was very instinct-based, right?
And it was all risk.
Yeah.
Because he probably knew any stocks at that point in time.
Sure.
And
Right?
starting off quite early. Yeah.
Yes, and given all the stories that he had told me,
Yeah.
I trusted him.
Yeah,
I was
you
like,
said
this
yeah.
guy knows his what, right? so, but I was quite lucky.
Yeah.
For 3 years that I invested along with him,
Yes.
it multiplied. And then one day, you remember, I think 2006 of May when Reliance crashed, that
Yes.
Black Monday, as they call it.
Yes.
I saw money market going half.
Yeah.
But that's where it comes in. Just stay invested.
And that's where the learning came in.
Absolutely.
Good. Santosh.
First
First ever investment.
Okay, so I've got two stories in that
Okay.
case, right? So the first ever investment was, again, I got lucky. My father was a banker with Citibank, and I had, a piggy bank, right? I had a piggy bank, and he just says, "What are you doing with that?" And he actually told me the story. He says, how much do you have? Whatever it was, let's say 100 dirhams. And he said, all right, great. If it stays in that piggy bank for the next 10 years, how much will it be? I said, yeah, if I don't put anything more, it'll still be 100 dirhams.
Yes.
Okay, great. Now, how about if you actually end up doing something with it? I said, what can I do with it? And he started talking to me about, a deposit. He started talking to me about a bunch of other investment products and so forth. And I said, great. I just realized, I'm like, wait a second, $100 could become 1,000. If I stayed invested in this. And he goes, yeah. He said, okay, let's go to the bank. So at that point in time, so my first investment was probably when I was 8, 9.
Okay.
And they had a kiddie, account that you could actually end up opening. So that was my first investment
Nice.
in a deposit. My first investment as an adult, of my first.
And probably deposits were earning quite fancy that time.
At that point in time, yeah. So, so I would go back and look at, I feel so happy, right? I'm like, hey, listen, guys, I actually have, my money, my 100 has become 102, right? But again, my adult time, I actually kind of, started investing in equities.
Okay.
So, well, again, I was within the equity, plethora. I was actually in equity sales. I was doing that for a living. I understood that. I did I was basically doing research. And sales, and I said, all right, fine. This, the first salary, the savings or whatever it was, I started looking at it, investing. Coming back to your point, at that point, my savings were fairly meager. I couldn't think of having a diversified portfolio,
Absolutely.
risk allocation.
Yeah.
So it was invest in one stock. I still
Correct.
remember that. I invested all my money in Dell.
I think we all did that. So that's really before and after.
Yeah.
Yes.
So, the other thing here, just to add from where Santosh is, right? Depending on where you are in the journey, you're either in wealth creation mode
Yes.
or you're in
In
wealth
wealth preservation
preservation
mode.
mode.
Yeah.
Okay, nice.
And in wealth creation, you're going to have to take concentrated bets, right? If I save 5,000 dirhams a month and I can afford a house in Dubai, I'm going to ask myself, 20 times, 200 times whether I should buy it here. Should I buy Dubai or not? Should I buy Dubai Hills or should I buy? You'll go through that a lot because that's all that you have. You're putting all your eggs in one basket,
Correct.
and you're hoping that this will at some point in time become a nest egg for you, right? And that's wealth creation. So you really try and evaluate that one particular opportunity, and if you're able to get that right, you hope that your money multiplies. When you have a much larger pool of capital, you're willing to study enough to be able to say, okay, this is what I like, but I'm taking diversified bets, right? So my bigger thing is that my $100 should not become 95, right?
Yes.
It can become 105 or it can become 125. But the growth of that capital is not necessarily at the same speed as when it is in the wealth creation mode.
Right.
But remember, wealth creation mode is also wealth destruction mode, right? If you don't study it well,
Yes.
right, it will tank. And
Yes.
there is most people tend to believe that with high risk comes higher returns. There is a time beyond which that high risk peaks out, right? And you can keep adding risk, but the returns won't go up.
Yes.
Right? So if somebody is telling me that you can make 200% return on this the next year, I'm sorry, I don't believe you.
Yes.
Right?
Okay.
Yeah, I'm just at that point where even if it could, I just don't believe you.
Okay. You still didn't tell us your first investment opportunity. You can't escape, Prashant. Sorry, I'm right here.
So, like I said, my dad, used to work. He was a government servant back in India. But my dad was actively investing in the stock market, right? And back in the day, we had equity forms that we would handwrite and fill. So for every form that we filled up, he would give me, 1 rupee in India, saying that this is. And if we got an allocation, we would get an extra 100 rupees. So and I would wonder why would I get 100 rupees if we got an allocation, right?
Yeah.
But in the IPO process, he would make some money, and he wanted us to sort of understand that as a process.
Yes.
That's how we collected the initial pool of capital, and then we went to him one day, and we're like, Dad, can I put my own money? And he's like, I'll tell you which stock to invest in. Hold on. Okay. So then he did not make us. He didn't tell me go put money into the stock. Right? He's like, these are the new IPOs that are coming, and this is what I think about them. Right? But why don't you read about it?
Nice.
And this is the time where the only information that was available was financial dailies. Right? I can't go out and Google the information and come back to him. So I had no choice but to start reading. And we went back to him. He'd explained, what the 52-week high lows were, what the comparables at that time was. So everything again boils down to education, right?
Yes.
And he actually spent a lot of time in teaching both me and my brother, in simplistic terms, why a business was what it was, what it could be 10 years hence, and what the value of that money could be, right? And that's so. Again, my first investment is also equity, but we did equity more out of research than out of trust.
Yes.
Because the journey from that trust to research had already been covered with my father. And we'd lost a fair bit of money in the trust-based investing and eventually gone into research-based investing. So my dad had figured it out that I need to invest, right? But the trust-based investing was out because you'd spoken to friends and advisors who'd said buy this or buy that. But when the stock corrected, they were not there in the picture, and you didn't know who to go and ask. So we moved from there up that curve to education.
That's sorry, if I may, that's actually very good because we're talking about the education bit of it. And I've got a 12-year-old daughter now. At her 10th birthday, I said, you know what? I'm not going to get you a gift.
Yeah.
I'm going to give you some money. All right, it'll be in your name. And you'll have access to it when you are 18, 19, 20. Think of it as your education fund.
Okay.
But you're going to be managing that.
Okay.
You go and research 3 companies, and I will help you, refine that research. And she came back, and for the last 3 years, she's been investing her own money. But again, she's actually, okay, fine. There'll probably be in weeks when she wouldn't look at it.
Yeah.
But the whole idea is she'll come back and she'll say, why is this gone down, or why is this up, or what can I do, or and it's all about education.
Yeah. So it's setting the precedent, basically on what can come forward.
You can never teach. It's never too early.
But can I just
Malika?
add something there? I think I guess Santosh had a very constructive introduction to investing. Probably Prashant did as well.
Very structured, very process oriented.
Like, my dad is into business.
Yes.
Right. I never got that. But what I want to bring out is the familiarity bias. Right. So they both probably had a bias towards investing into stocks early. Or probably you learn about deposits. I learned only real estate. So the moment I started working, my only goal, the first goal was to buy a house. How soon can I do that? Because that's all I had seen all my life. Because my dad, he kept buying properties, kept selling them, just as investments. And I probably saw it like for 20 years, right? So my first investment after those stocks was my house. The year I graduated.
Yeah. And it's also, and I think it's also the mode of thinking, especially when you come from an old school thinking. If I were to speak to a couple of my uncles or my aunts as well, they like to see their money. And when I say see, like it's got to be something that's a little bit more tangible, right?
Yeah.
And I think, investing in a lot of equity and stock, and it's also what you know. And so the more you expand your horizon.
Absolutely.
Yeah.
So one needs to come over that.
Yeah, yeah.
Like and like Prashant was saying, whether it is something like you want to rush from investing or something like slow compound. Like for my 13-year-old kid,
Yeah.
they just introduced. They had a competition just for a month.
Yes.
Right, in Dubai.
Yeah, yeah.
And everybody is giving like virtual $200,000, and they're gonna see after a month who's gonna be the winner. And the day it opened, I see a kid right at the top chart, like within 3 days, $1 million. All he did was to buy GameStop. Like that's all he did.
That's all he did, yeah.
And that is where it comes from.
Yeah.
For wealth creation, you need to take a concentrated bet.
All
So
right.
he put all his $200,000, in
And then-
one shot.
and he just shot it in.
But Malika, this guy would have, because it was virtual money, you could do it with GameStop.
No, I'm just saying as an example.
I
right?
agree. I'm just saying that, we need to be able to distinguish between, what was consistent compounding and what was luck. Right?
Absolutely.
A lot of times people mistake luck for great investing. Right? Oh, he bought this and it's gone up 5x.
Yeah.
He's
Look
a
at
great
him go.
investor. I'm sorry, he isn't. Right?
Correct.
If you're not able to demonstrate that over years,
Yeah.
right? You just got lucky.
Yeah.
And people can get lucky a lot of times, right?
Okay.
I've seen people get lucky a lot of times.
Yeah.
These are people that take a lot of bets.
Yes.
Right?
Yeah.
You only hear about the ones that win.
Yeah.
Right?
You don't
If-
hear about the losses.
But there may be somebody that's made a fair bit of money on a few concentrated positions, but distinguish between an investor
Yeah.
and a lucky person, right? And they're two different people. If I came to you today and I said, here's a pot,
Yeah.
this is a plant, and you know what, tomorrow you're going to get apples on this because this tree will grow up tomorrow.
Yes.
You won't believe me.
Yeah.
But if I told you, this stock's going to be 3x in 5 days because I know the CEO,
Yes.
somehow you have a tendency to believe.
Yes.
It's the same thing. If you've not spent time nourishing it, if you've not spent time, knowing what it is, you don't know the fruit that comes.
The point I was bringing was about the trading fatigue, right? So here's my son. He looks at that kid, and he's probably right at top chart, and he's probably still 20th out of those 110 kids, and he's trying to keep up. And then he comes back after a week. I cannot do this.
Yeah. Yeah.
I want to, I cannot do this trading thing every day.
Yeah,
I want to, invest those $200,000 and not look at them.
Yeah.
I want to buy the solid ones, mama.
And then just assume
And just
it's going to
sleep
work
on
on
it.
its own. Yeah.
That's right.
All right, so we're going to do some fireball questions because we're running out of time, but I love this conversation. Like, I can all three of you be my financial advisors because I'm looking at...
Happy to.
I think I have the upper hand, being, the host and all. But anyway, okay, just a quick fireball questions because I really want us to kind of hone in with, like, final takeaways from everybody. Should you stop the minute, just a quick yes or no, should you stop the minute you lose out on an opportunity? Yes or no? Let's start with you, Santosh.
No.
Malika?
No.
No.
No. All right. If you spot an opportunity that you're 50-50 about, you're not really sure, you don't know much about it, what should you do? 3 things.
I wouldn't do anything. I'd learn more about it.
Okay.
And
For how long?
well, okay, I'm programmed in a very research-oriented
Yes.
way, so it's probably a wrong answer. Or the fact that I don't take 50-50 bets.
Okay.
All right, the whole idea is, you want to basically make sure that I've actually got at least a 51%. It's a game theory.
Got
I want
it.
to make sure that I have 51% chance.
Okay.
Absolutely.
I think we're all aligned.
Are they
with
all
that,
aligned
right?
with that?
Absolutely.
So the moment, I think at 50-50, you want to read more.
Okay.
And you can't wait to 100%. So if you're 60-65% there, take the call.
Yeah.
Okay. All right. We'll start on this side of the table now. The best investment you've ever made. Please don't mention my family, my kids, because that's a given. Best investment you made.
Myself.
Education.
Education. Yes.
Education.
More than anything else.
That's the biggest. And investing in yourself, investing in honing your skills, right?
Yes.
I guess that's the biggest thing that you can do. Monetarily, equities. 100%.
Amazing. Malika?
Real estate.
Real estate.
After, investing in yourself.
Similar. I think for me it is myself, and I think probably a large part of it has got to do with my fourth quadrant, which I didn't talk about, which is in venture capital and private equity. Because for me, the way I look at it is the fourth quadrant is extremely low liquidity and extremely high risk. So
I think we need a session about that. We might have to speak to KEF Connect about it. All right, so I'm gonna before I end, we'll start with Malika, but before we go into what are the 3 number 1 things that people should do when they're thinking or about to start investing.
Okay, I think like you said, the first is define your objective, define your investment horizon, and asset allocation. Sorry, the third thing should be actually defining your risk profile. And once you've all done that, then your asset allocation.
All right. Santosh?
Okay, I think, I think probably the most easiest or the first thing that you need to start or one needs to start with is defining the objective. That goes without saying. I think risk automatically comes, I think is an overlay within the objective part of it.
Yeah.
So, what is risk, what does risk mean to you? I.e., how much of that can you actually, lose, not lose, and again, the third and the most important bit is education. I think you really need to kind of drill down to it. And please stop taking tips from from someone who actually says this is a great stock to buy. Or from CNBC.
All right, and let's
right. So
close
I
out
think
with
when you started this, you said a lot of people need to ask themselves this question on whether investing is for me or not. And I think number 1, convince yourself that investing is for you. I don't think there's anybody in the world that should not invest. Right. So number 1, go out there, tell yourself you need to invest. If there's something that's stopping you from investing, ask yourself what's that reason. Try and overcome that, right? Find your cure. Find what is it that stops you from investing. Educate yourself. Get over that fear, but invest, right? So, I mean, should anybody invest? Yes, they should. I mean, there is no doubt. You could be earning 100 dirhams a month or 100 million a month. It doesn't matter. But you should go out there. You should be investing. Number 1, right? Number 2, also number 1, is educate, right? Research, educate, learn, repeat, right? Just keep doing that as a process. You will get better at it. 3, don't give up. I think that's just it. You will. Money is something that will event, and once you get it, it's just simple. You get it. It's getting to that point where you realize that this process now works for me, and everybody finds that process. Right? And my process is going to be different from Santosh, it's going to be different from Malika's. But you know what? All 3 of them make money.
Yes.
Right? Yeah. I'm sorry, I'm just a little longer than...
No, don't apologize.
A jeweler makes money, a F&B outlet makes money, a radio station makes money. They all make money in different in different ways.
Yeah.
Right? They all have different processes.
Correct.
But they still end up making money.
Yeah.
So don't worry about what the other person's investment objective is. Don't worry about whether they make more or they make less. Find your own. We're all individuals. We all have our own needs, our own defined objectives, and that's what we meet with our investment purpose.
Sure, if I may just add one small point to that, I think and I think these are great points. But just to add to that, I think what you actually were talking about is discipline as well.
Yes,
absolutely.
It's absolutely so important. Agree. You know what? That actually you're disciplined with, and you've got to set your own process.
Consistency and coherency make for everything to be successful. I want to absolutely thank you guys, Prashant, Malika, Santosh. It has been phenomenal. There's so many learnings to it. I think there's a lot of education that we need to basically backtrack on our own just to decide. My name is Aida Busaidy, and today was KEF Connect about money. Such a pleasure. See you next week.